All right, welcome back. Today we're going to look at income inequality and discuss some of the programs available by the U.S. federal government to deal with income inequality and redistribution of income. In class, we're going to talk a little bit more about how do you measure the degree of inequality, and we'll talk a little bit about the appropriateness of various policies. This information is in Chapter 19 of your book, and we'll start by talking first about poverty. And poverty is a number that is calculated by the Census Bureau, and it includes people's pre-tax income, excluding any sort of benefits that they may get from the government or capital gains or any other source of income other than salaries. And it makes an assumption that you spend about 30% of your budget on food. And so they calculate a number that then indicates what is considered the poverty line. And the poverty line depends on the number of people in your household and the number of children that you have under the age of 18. So it's a little bit of a sliding scale. But it basically represents the bare minimum income that you would need to be able to survive. Now, there are a lot of reasons why people may enter into poverty in the United States or around the world. A couple of these factors are things like education. The lower level of education you have, the more likely you are to fall at or below the poverty line. Marital status is another thing that goes into it. It's another factor that has a significant impact. Single people tend to have a greater percent chance of being at or below the poverty line. Your native language, if you're not a native English speaker, we find that in the United States, people who are non-native English speakers tend to have a higher degree of poverty. The type of job you do, part-time workers tend to have higher levels of poverty than those who work full-time. And sometimes we do see a degree of discrimination. We find that women and minorities are more likely to experience high poverty rates than men do. There are a number of programs that the government offers to try and deal with poverty, and these programs generally have two characteristics. They tend to either be means tested, which means that basically your benefits are determined by your income, and the more income you have, the less of a benefit you receive, and the lower income, the more help you receive. And then the other characteristic is one of whether or not the program is a money transfer or an in-kind contribution. So whether the program is giving you straight cash or whether or not you're receiving goods and services in lieu of cash to help deal with an issue. And so what we can do is create a matrix that will help us to characterize various programs that the government offers. So when we look at this matrix, we can see that means-tested programs that look to see whether you meet a certain qualification or not, are things like temporary assistance for needy families or the Earned Income Tax Credit, Medicaid, or food stamps. These programs are only available to people who have a certain income level, as opposed to not means tested, which is things like Social Security or Medicare or unemployment, where it doesn't matter how much income you had. If you are over the age of 67, you get Social Security. If you're over the age of 67, you get Medicare. If you're unemployed and looking for a job, you get unemployment insurance. It doesn't matter if last week you were earning $1 million as a CEO or not. Now, the other part of it is we can look at it as far as money transfers go. Things like temporary assistance for needy families or Social Security, those types of programs involve you receiving an actual check that you could cash and then use, as opposed to in-kind benefits, which are things like food stamps, where you have a voucher where you can take that voucher and you can go and buy food with it, but it's not really cash because you can't buy anything else other than food. Or Medicare, which is an in-kind benefit in the sense that you go and you receive doctor's care. You don't have to pay for it, but you don't get a check that you can cash and use for something else that is specifically the good or service that you receive. One comment on the Earned Income Tax Credit, and that is that the Earned Income Tax Credit is essentially a negative income tax. That's basically a straight transfer from the wealthiest of people to the poorest of people. If you earn the Earned Income Tax Credit, then basically what the government does is it pays you money from the taxes received. So if you earn very little in income, you actually will receive a check from the government. Instead of paying income tax, you will be given money from other taxpayers through the government to help supplement your income. So how good a job does the government do in distributing income? When we look at numbers from 2010 from the Congressional Budget Office, which is the latest data that was available at the time I recorded this, we can see that for the most part, the vast majority of income is distributed towards the upper quintiles, the fourth and fifth quintiles of income. So most of the money and wealth in our country is in the upper levels of income. But then after the taxation that goes on, we can see that the government generally redistributes that wealth down from the top, mostly towards the middle. As you can see, both the second quintile, third quintile, and fourth quintile actually increase their share of total income after taxes. One of the things that we want to do is to be able to measure how much we've redistributed income, or said a different way, how much inequality is there in the distribution of income. And to do that, we use what's called the Lorenz Curve. The Lorenz Curve gives us a tool that helps us identify how equally or unequally income is distributed. And what the curve does is it looks at two things. It looks at the percentage of households, and it looks at the percentage of total income that those households represent. And we use the curve itself to calculate what's called a Gini coefficient. And so here's what the Lorenz curve would look like. Basically what we're seeing here is that in a perfect world where there's equal income distribution, then the bottom 1% of households would represent 1% of income, and the bottom 2% would represent 2% of income, and so it would be a perfect correlation, so that the 99% of income is held by 99% of households all the way up to 100. So that's sort of the ideal if there's perfect equality. Then we measure the real distribution of income, which is usually or almost always something less than perfect. So we can see that maybe the bottom 2% of incomes, households in the country represent only 0.5% of actual income, whereas the upper levels, the top 1% maybe represents 30% of total income, and that would be an indication of it being unequally distributed. And so economists use this data and this chart to then calculate a number called the Gini coefficient. And that Gini coefficient ranges from 0 to 1. If it's a 0, it means that income is equally distributed to everybody. And so it is perfectly along that 45-degree line you saw in the graph. And if it's a 1, it means that basically income is perfectly unequal, that one person holds all of the income and everyone else has nothing. And so all countries kind of fall in between those two extremes. For the United States, the last time it was measured that I could find, we had a Gini coefficient of 0.468. So we're not highly equal, but we're also not highly unequal. We're sort of in the middle. And if we look at a map of global Gini coefficients, we'd see that there are some countries that have a much lower Gini coefficient, largely in Europe, and other countries where there's a much higher Gini coefficient with a strongly unequal distribution of income, particularly in some of the South American countries that you see on the map. We'll talk more about all of this when I see you in class. See you then.